Can I introduce you all to Paul Fisher and myself? We're going to talk a little bit about economics in terms of reality and theory. I'm a professor of economics. Paul is a doctor and professor of economics. I have spent all my life teaching economics from a theoretical background, in as much as I've been tutoring undergraduates and graduates, whereas Paul, an excellent economist, has also been doing things on the practical side of the subject. He was head of executive markets at the Bank of England, private secretary to Eddie George. He's been on the Monetary Policy Committee, and he was on the Monetary Policy Committee under Mervyn King and Mark Carney. We've had discussions in the past about various matters in economics, and we thought we would put together a few little chats so that people can see that economists who disagree with each other are not necessarily at loggerheads all the time. I know Paul's got 3 questions he wants to go through today with regard to something which is very current, and that's inflation. So I'll pass you over to Paul to pose the first question.
Thanks very much, John. Now we know we don't agree on everything, but one thing I think we do agree on is the importance of keeping inflation low and stable. But I don't know if we think about that for the same reasons. So what's your take on why we need to keep inflation low and stable? After all, some people will say this is yesterday's problems. Inflation was defeated 10 years ago. Why are we still worried about it?
Right, my concern about inflation is that for capitalism to work, for the economy to work, we need stable prices. Now, ideally, I would like a system which creates zero inflation, no inflation whatsoever. However, because we record these statistics every month, to create a zero number for inflation, what we would find is that there are some months when we dip below zero and some months above to create this average. And I'm very much aware as an economist that if you have deflation creeping into a system, that can begin to change people's perceptions of what is going on. And if people actually see prices falling, what they tend to do is put back purchases. And when you put back purchases, that lowers the velocity of circulation of money, and that can make the deflationary situation even worse. So I'm quite happy to accept that the central bank should target a positive number for inflation, shall we say 2%. And that in trying to achieve 2%, we won't then drift into a negative number. I don't think 2% inflation is good. I just think it's the best situation that we can find ourselves in to create that level of stability in an economy for the economy to work efficiently. What's your thoughts, Paul?
Okay, I've got a number of thoughts. I don't disagree with any of that. First of all, inflation is not dead. As we speak today, about half the people on the planet live in countries with inflation over 5%. The idea that inflation is low and dead is very much something for Western developed markets. It's not true in most of the developing countries and never has been. That's the first thing. The second thing is that inflation is essentially a tax, and it's a tax which impacts much more on the poor than on the rich. It's a regressive tax. And so if we want to move to a fairer, more equitable society, we need to keep inflation low. Often the measures that are taken to keep inflation low seem to benefit the rich, but actually the main purpose in keeping inflation low is for the poor who have no defence against inflation. A third reason is actually allied with John's, in that in order for the economy to work properly, we need price signals to act. And when you have general inflation, price signals don't work very well in terms of allocating resources in the economy. Now, I do quite a lot of work on the sustainable economy. How do we make this economy sustainable in the long term? For that, we need stable economic conditions so that people can plan and invest for the long term, not the short term. And if you have high short-term rates of inflation, that long-term investment is going to suffer. And so again, from a sustainability perspective, I want to see long-term low and stable inflation. John talks about 2% not being optimal. It's true that the main reason why we go for 2%, the two reasons. One is around 2% inflation, it tends to be the most stable level in terms of the least variance. But also we know that price indices as measured probably overestimate the inflation rate a bit in terms of, for example, quality improvements not being properly reflected in price indices. So 2% inflation is, as measured, is probably consistent with the somewhat lower actual underlying inflation rate.
Thank you, Paul. It's an interesting story there, and it must be something that we'll talk about on another occasion, but Paul did recognise the measure of inflation, and if you read my blog, you'll see there's an explanation of why RPI is what I consider to be the best measure of inflation, not CPI, that the Bank of England has chosen. My argument always is that CPI undervalues the rate of inflation by approximately 1% or even more. In fact, the current situation, I think we have, what's the current CPI rate? We're looking at about 3.2, isn't it?
No, it's almost exactly 2 in the UK now because it's dropped very sharply in the last couple of months. It was 3.2.
Come on, Paul, wake up. The figures came out a couple of days ago. It's now up, the biggest increase in 1 month since 1997 when CPI started. It's now up at 3.2.
Wow. Okay.
And not only that, is RPI is 4.8. What's your next question, Paul?
Well, whatever the measured inflation rate is right now, and I think it's interesting that it's the volatility which comes through most clearly from that discussion. What is it that causes inflation ultimately? John, what's your view?
Well, that's right. I mean, I have quite a simple explanation of the cause of inflation, and that's Paul, as he was. Of course, that's the central bank. The central bank causes all inflations, and the reason that that is the case is that by definition, inflation is too much money chasing too few goods, or more units of money used in the same number of transactions. Now, if inflation is more units of money used in the same number of transactions, then you ask yourself the question, where do more units of money come from? They don't come from higher oil prices or higher wages or higher commodity prices or higher energy prices. They don't increase the number of units of money that measure inflation. The only place that they can come from is a central bank. So a central bank must cause a change in the average. So there's no such thing as cost push inflation. Forget those textbooks that tell you about cost push inflation. That's a myth. You can have cost push pressures. You can have pressures caused by costs which might cause a central bank to react in such a way as to cause inflation, but at the end of the day there is only one cause of inflation, and that is the way the central bank manages its monetary policy.
Well, of course, John is completely wrong on this. It is true that in countries with high inflation rates, that is almost always associated with high rates of money growth, and that is predominantly, if you like, the channel through which the inflation is being allowed to occur. That high money growth in most of those countries, not all of them, but in most of those countries is generated because governments spend too much money, and they spend more than they can raise in taxes and debt, and they end up printing money in order to finance expenditure. That leads to money growth, and that leads to higher inflation. But increased money in itself doesn't mean high inflation. So at the start of the pandemic, what we saw in countries, quite diverse countries from the UK through to Oman, is a sudden jump in the demand for notes and coin. So the narrow base, the money supply, went up at a time when the number of transactions went down. And when we look at the research, we find that most of the money that's held by people is not held for transactions purposes. It's held as a store of value or as a precautionary motive. And what that means is the link between the stock of money, however you want to measure it, and the activity, the nominal level of activity in the economy or the inflation rate, is very weak. There are other influences which affect that translation from money into activity and into prices. And so we need to be cautious about putting inflation down to purely monetary phenomena. What is true, where I agree with John, is that if you have inflation, the central bank can take action to control it. We know that if you tighten monetary policy sufficiently, raising interest rates or reducing the money supply, however you want to think about it, you can bring inflation down. That is not a precise science. Often you might have to raise interest rates or tighten monetary policy a lot to get inflation under control. Sometimes you can do it with the gentlest of nudges, but we know you can do it. It's actually harder to get inflation up, and this has been shown in decades in Japan and in Western countries more recently. When inflation is too low for your liking, trying to loosen monetary policy enough to stimulate inflation can be actually very difficult. But I agree that fundamentally you can control inflation through monetary means, but I don't agree that the inflation impulses are always and everywhere monetary.
I think somewhere where we're sort of agreeing and disagreeing is to do with the difference between the amount of money in the economy and monetary demand. And I always try and explain monetary demand as being two components. It's the stock of money and the speed it goes round. So if you looked at the pandemic, you've got a situation where furlough payments, increased spending by government, no increase in taxation, led to a situation where there was significant growth in money stock. But at the same time, you locked people down, and because you locked people down, you had a slowing in the velocity of circulation of money. Those two components together are indeterminate as far as monetary demand is concerned. Monetary demand could have grown or declined as the result of increase in M, reduction in V. However, if you return to normal, then when you return to normal, you will get M and V back to a previous level, and as far as I'm concerned, you get inflation. Now, I predicted in April 2020 that what was going on would lead to money supply increases, which would eventually feed through in the economy to higher inflation. And there is a time lag with this happening, which is anything between 12 and 24 months. Let's take 18 months as somewhere in the middle. So you would expect inflation in the UK now to be picking up and rising. And as I pointed out to Paul just now, inflation is doing just that. It's now up at 3.2% as far as CPI is concerned, and 4.8% as far as RPI is concerned. And in my mind, this is going to continue to go up. So I will go back and say the central bank is key to all of the inflation that we have. And if you follow central bank actions and look at broad monetary growth and give a time lag to that, then you've got a fairly concise idea about what's going to happen to inflation. So a few basic things we agree about, but I'm much more critical of the Bank of England than Paul is.
Yeah. So just to put some of this in context, what's happening this year is inflation is being very volatile. When it can change from 2% one month to 3.2% the next, there is nothing the central bank can do about monthly movements in inflation. What it affects is inflationary conditions overall. And what we saw last year, 2020, during the pandemic, around the world, inflation generally fell. Not every country had inflation falls, but most countries' inflation fell often below targets, where countries were inflation targeting. Part of that was a relative price change in terms of the price of oil falling. That's not really an inflation change, it's just a short-term relative inflation measure. And what we're seeing this year is some bounce back in 2021 from what happened in 2020. And so it's difficult to gauge inflationary trends from the monthly figures, because what happens in the 12-month rate this year really reflects what happened this time 12 months ago. And so it's quite difficult to judge inflationary pressure from these sorts of measures. What a central bank has to do is judge the overall inflationary trends. Now, where I would agree with John is actually what's happening in America, where inflation has gone somewhat higher, over 5% during the course of this year, and that is a deliberate monetary impulse by the Federal Reserve. And in fact, they changed their policy to say they wanted to run inflation above 2% as often as below it, so that on average the price level would change by 2% every year. So I think you've got a more clear demonstration of John's point in the US, where we are seeing inflation as a result of a direct central bank monetary impulse.
And I suppose we should date this, shouldn't we? We are in 2021, the end of September, and Paul and I spoke about this some time ago, and I suggested to Paul that by the end of this year, which would be the statistics recorded in January 2022, inflation in the UK will be closer to 7% than it will be to 2%. And Paul conceded it will probably be about...
Well, I think inflation will probably be above 2, but I think it'll be closer to 2 than 7.
That's right, yeah. So you were down at that level. So something for people to look out on, isn't it?
Yeah.
What was your third question, Paul?
Well, thirdly, we've looked at why it's important to keep inflation low and stable. We've then discussed briefly the causes of inflation. So the next question is, what should we do about it? And so what should we do when inflation is high, and what should we do when inflation is low? Should we even wait for the inflation outturn before we act, or should we be looking at expected inflation?
Very good questions. As far as I'm concerned, because if we go back to my previous point, the central bank determines the rate of inflation, then from my point of view, it doesn't have to react to what the inflation rate is, because it's actually causing that inflation in the first place. So I would like my central bank to do the only thing I think it can do, which is maintain a rate of inflation which is stable and around 2%. I do think there was a significant problem after the global financial crisis, where the initial attempt to try and take us out of what could have been a deflationary and a depression situation was to go for fiscal policy. So that we went for a situation where we were trying to boost aggregate monetary demand through fiscal policy, and that didn't seem to work. And it almost seemed as though the government of the day said, I'm sorry, the Treasury fiscal policy hasn't really worked. Over to you, Bank of England. It's up to you to boost the economy, to grow the economy, to create jobs, to avoid deflation. And in a sense, the Bank of England was almost given a list of things, one of which it could do, but the others it can't do. The Bank of England cannot grow the economy. The Bank of England cannot create economic growth. The Bank of England cannot create jobs. What the Bank of England can do is stabilise prices. So the Bank of England can actually achieve its target for inflation if it had no other thoughts in its mind. If it had the thoughts of we've got to grow, we've got to close the output gap, we've got to push support for fiscal policy, we need to grow the money supply through things like QE, then I think it has a problem. And I do think that all of the fluctuations in prices come down to the fact that the Bank of England is trying to do too much. It can do one thing, it can maintain stable prices. But if you ask it to do all these other things that it can't do, that's when things become, or where the economy changes, where we end up getting volatility and things which are not particularly stable. And if we go right back to the really first big bout of QE, then I'm quite happy. It was the right thing to do. To avoid deflation, we needed to boost monetary growth, and QE did that. Now I'm sure Paul can answer this, but I'm sure the Bank of England didn't know how much QE to do, but it knew that it should be enough. What enough was. So if we're going to make a mistake on this, we had better make a mistake on it being too much, not too little, because too little is the problem we're trying to overcome. We don't want deflation. And if my memory serves me correctly, and Paul may correct me here, after the first big bout of QE, inflation did lift, and it did lift above 2%, and it did achieve nearly 6%, because the Bank of England had overdone it. But why not? Because they don't know how much they've got to put in. All they know is they've got to put some in, which they did, and they avoided deflation.
Well, of course, I agree with John on some things and not on others. I agree with John, actually, that it's not the central bank's job to try to grow output above its normal rate. I think the central bank can nudge output that's excessively low back towards its proper point as part of trying to stimulate inflation, and I think it can bring output down to its normal rate as part of controlling excessive inflation when you have a demand shock. But I think you see this problem actually more in Europe, where the ECB has unfairly been criticised for failing to stimulate the economy. And in fact, the European economy is sluggish not for reasons of demand management or monetary policy, but because of poor supply side conditions. European governments are very reluctant to improve their supply sides because of vested interests, and that therefore unwarranted expectations are being placed on the ECB to try to stimulate growth, which they can't do. I think you also see it in America, where the Federal Reserve ridiculously has the famous dual mandate, equal responsibility for output growth and employment as well as inflation. And the responsibility for output growth and employment fairly squarely rests with the government, who have control of tax, of spending, of labour market legislations, of things which directly affect productivity and population growth, which the central bank simply doesn't have. But in terms of controlling inflation in the short run, once inflation is reasonably low and stable, say anywhere between 0 and 5, the monetary policy is not anywhere near precise enough to control inflation at a particular level. But what seems to work is this. People adjust wages and prices in relation to what they expect everybody else to be doing. And if the expectation is expected to be low and stable at around 2%, people setting wages and prices will adjust their own wages and prices to be consistent with that expectation. And the central bank's job becomes that of changing monetary policy to convince people that inflation is going to be at or around 2%. And if they manage to do that, then lo and behold, behaviour dictates that's the outcome, almost regardless of the level of money supply and interest rates that are underlying it. And the big risks are either that you get stuck with high inflation expectations, in which case the central bank can do something to affect that and bring inflation down, but it's very expensive and very difficult. You have to tighten monetary policy a lot to shift people's expectations downwards. And the other risk is you get stuck into very low inflation below the desired level, and it's very difficult to try and stimulate that inflation with monetary policy. We've had 10 years or more now of very excessive money growth by central banks that has struggled to get inflation up. Finally, it's succeeding, although I'm not sure that the current volatility and levels of inflation have anything to do with monetary growth. I think they're more to do with short run and relative price effects than anything else. But fundamentally, I think we agree with that it's central bank's responsibility to keep inflation under control in the medium term. I don't think either of us think you can do that month to month, given the vagaries of how inflation is measured. And I think we both agree that it is not for the central bank to try and control the level of output, which is given by things in the real economy, not by monetary policy.
Thank you, Paul. We hope you've enjoyed this. It's a nice sunny day. Paul came round for a barbecue, and we thought it might be interesting if we had a little chat which we could add to my YouTube channel. So if you are seeing this, it means we've then looked back over this and thought we stand by what we have said. We are thinking of getting together and talking about a number of other issues with regard to the economy, a whole range often of macroeconomic topics, because that's where the real interest is. So we hope you enjoy this, and if you found it useful, do let us know, and we will endeavour to follow up with some other interesting discourse with two economists who agree with each other to a certain extent, but have sort of diverged often. Paul has the expertise of knowing what life is like out in the real world, whereas I have no expertise of what life is like in the real world. I just have my ideas as an economist about how the theory should work, and get quite upset when it doesn't work exactly as I think. Thank you very much.
Thank you,
All
John.
right.